Hello dear students, I am Jay Prakash, retired lecturer from Telangana Resident School Society, Hyderabad. In today's class, we are going to discuss various depreciation methods. In the textbooks, we have 10 methods of depreciation, and among them, two depreciation methods are important for problem solving. They are the fixed installment method and the diminishing balance method. So, important methods for problem solving are first one, fixed installment method and diminishing balance method. Now, what is a fixed installment method? This method is so simple and very easy to calculate. Under this method, depreciation is charged or provided every year on the original cost of the asset. So what is the original cost of the asset? Means not only purchase price, and it should also include on freight and installation and transportation or erection charges are to be taken into consideration. So when the percent is given and the depreciation amount is uniform throughout all the lifespan of the asset. This method provides depreciation uniformly, no change in the depreciation, as in the example case 2500 provided for 4 years. So amount also fixed, the 2500 and for all years. This method is also known as a straight line method or equal installment method and original cost method. This method is suitable for assets like landed buildings, patents and trademarks. So when the amount of depreciation presented on the graph paper, the paper shows only straight line on the graph, and that's why we are calling it as a straight line method. Example, on 1st April 2010, a machine was purchased for rupees 12,000 and expected life is 4 years and scrap value is rupees 2,000. To find out annual depreciation is equal to cost of the asset minus scrap value divided by estimated life EL is equal to 12,000 minus and 2,000 is equal to 10,000 and divided by 4, 2,500 is in a depreciation amount. Now to find out the rate of depreciation, that is RD, annual depreciation AD and divided by cost of the asset CA into 100, 2,500 and divided by 12,000 into 100. So the percentage of rate of depreciation or percentage is 21% approximately. Calculation of depreciation under the fixed installment method, the principle is annual depreciation AD, cost of the asset is CA, now scrap value is SV, now estimated life EL are of the asset, and now so AD is equal and means annual depreciation is equal cost of the asset minus and SV and divided by the EL. So RD is equal to and annual depreciation by CA into 100. Now this method, the various advantages are, now this method is very easy to understand and they're simple to calculate. A ordinary person can calculate or solve the problem under this method. Now under this method, the value of the asset will become 0, written off up to the 0 point. Now equally depreciation is equally distributed throughout the lifespan of the asset. This method is only suitable or usable for the assets which have lesser value. This method applicable to only small farms, suitable for small farms. Now furniture and fixtures like such assets, only this method is suitable. Depreciation charge as well known to us, so that you know what is the and effect on in the profit and loss account. Now disadvantages under this method are fixed installment method, no provision for replacement of the asset, as every year we are providing depreciation, but this fund depreciation fund we are not keeping aside for replacement. Now interest, once we purchase the asset on by paying a certain amount, this method is does not take into account the interest on purchase of the asset. Pressure on the stock years, in the initial years repair charges are very less as the asset machine works very effectively. When later years it needs more repairs as we are providing a less amount of depreciation. This method is illogical because every year we are providing depreciation uniformly as the asset is life is going on decreasing as it needs more and more repairs. Now, this method is not suitable for the assets which have the long life, such as plant and machinery and buildings. Whenever the additions are made for expansion, this method is not suitable to in such cases. Now, second method is a diminishing balance method. Under this method, depreciation is provided in the initial year on original cost of the asset as we are provided in the fixed installment method. Such as, let us say example, in 2020, when we purchased a machine by paying rupees 12,000, depreciation is a 10 percentage. So the amount of depreciation is 1200 rupees. In the year 2021, so the second year depreciation is calculated on this value 12,000 minus 1200, that is 10,800, and depreciation is calculated in second year on 10,800 at the 10 percentage. So that is means amount 10,800 minus 1080 is equal to 9,720. In the third year, we have to calculate depreciation on 9,720 rupees, which is balance brought down amount. Depreciation is calculated every year, that is balance brought down value of the asset. So for the first year, the value of the asset is 12,000. In second year, the value of the asset is 10,800. In the third year, 9,720, and so on. And a rate of depreciation percentage remains constant, but the amount is going on decreasing year after the year. This method is known as reducing balance method or written down value method. Now, calculation of depreciation: first year 12,000 into 10 by 100, 1200 rupees. Second year 12,000 minus 1200, 10,800 into 10 percentage, 1080. Now, to find out the rate of depreciation in diminishing balance method, R is equal to 1 minus nth root of S by C into 100, whereas N stands for number of years and S stands for the scrap value, C stands for cost of the asset, and into 100. Now, this method provides certain advantages. What are they? Uniform effect in the profit and loss account. This depreciation method, diminishing balance method, provides depreciation in the initial stages, more amount of depreciation; in the latter stages, less amount of depreciation, and vice versa. Logical method: so as the depreciation matches with the service of the asset, more efficient. As the asset is more efficient in the initial years, we need less repair charges. As in due course, it needs more and more repairs. So as we are providing less depreciation, as it is working, functioning less. Third one, risk of obsolescence is recognized. We are anticipating that the machine is going to be outdated in due course. So based on that, we are charging depreciation in our books of accounts. Tax deferral: it means in the initial year we are providing depreciation more on the asset, such as you take an example in the previous as 1200 rupees, 1080, and so on. In such case, in the first year, as we shown 1200 rupees as a under depreciation, so that we get a less taxable income. As the years passes and as we are showing less amount of depreciation, so the taxable rate or income may be more. Now, this method is suitable for plant and machinery, furniture and fixtures, etc. This method is recognized by the income tax authorities 1961, as this method is a scientific and logical method, because in the initial year we are providing more amount of depreciation, later years the depreciation amount is less, that is recognized by the income tax authorities. Now, the disadvantages under this method or diminishing balance method are not suitable for all assets, such as the assets which have the short time life does not applicable to this one. Interest: this method is also not taken into consideration. The interest on an asset depreciation amount is not provided. High rate of depreciation: this method requires high rate of depreciation, that is a percentage. Now, book value of the asset: under this method, the asset value never becomes as zero as it was happen in our first method, the fixed installment method. In calculation, this method is very difficult in calculation depreciation, as every year we have to calculate depreciation on balance brought down. The amount of depreciation changes year by year, so that it is very and difficult in calculation of depreciation. Now, important points for calculation. So, as a student must remember on which date the asset was purchased. So, purchase date is most important to find out or to calculate the depreciation. Secondly, date of commencement. On which date the books of accounts are commencing, as is it is January 1st or it is in April 1st. What is the financial year of the business? We must notice it before starting the calculation. The thirdly, date of closing of the books. On which date the books are closing? Once you started the April, the books are closing at 31st of March. Hence, we have started January and the books are closing on 31st December of every year. These three things are to be remembered by the students to solve the problem under these methods, the fixed installment method and diminishing balance method. So other important depreciation method provided given in the textbooks are the third one, annuity method. This method taken into account and interest of the asset and it is calculated on the book value of the asset. It means that as we have spent amount on acquisition of an asset, suppose let us example 10,000 you have paid on 10,000. If you deposit this amount in any other bank or any other financial institution, we get some nominal rate of interest. Let us say example 1,000 rupees a nominal rate of interest. 10,000 plus 1,000 also should be taken into consideration. This annuity table method provided depreciation based on or following the annuity tables. This method is only suitable for leasehold property. Next, depreciation fund method. The amount written off as a depreciation is kept aside. Under this method, the amount is invested in any securities. This method provides for replacement of the asset. When the asset and life expires, the securities are sold off and new asset is purchased in place of the old asset. Depreciation is calculated under this method as per the sinking fund tables available in the office or in business. This method is suitable for and only leasehold property. Now, insurance policy method. Under this method, a policy is taken on the name of an asset. The premium is paid every year. At the end of the life of an asset, the insurance policy is sold off with that realized amount and the new asset is replaced or purchased. This method is suitable for the leasehold properties and oil wells, etc. Next method, depletion method. Depletion means here is nothing but extraction or digging and is only suitable for mines and quarries. Under this method, what is the quantity of the output available and in that area is estimated first. Quantity of output is divided by the cost of the asset is a annual depreciation. And this is multiplied with rate depreciation. Let us assume the cost of the mines for 10 lakh rupees, expected quantity available is 10,000 tons and now 10 lakh by 10,000 is 100 rupees and is then rate 100 per ton. Suppose in the first year we extracted 10,000 tons, 10,000 tons into 100 is equal to the 1 lakh rupees is an annual depreciation. Next method, a revaluation method. This method is only suitable for small loose tools and livestock and crockery. Means in the beginning of the year, we have assessed our value of the asset and at the end again we value of the asset. So depreciation is beginning value minus at the end value of the asset is in a depreciation. Mesh-hour method. Under this method, asset life is estimated in hours. Actual number of hours works a machine in a particular year is multiplied by hourly rate. That is, say annual depreciation is equal cost of the asset minus SV by year. This method is suitable for only the machine as we have calculated depreciation hourly basis. Mileage or kilometers method. This method is only suitable for the vehicles such as lorries and buses. Under this method, useful life of the asset is estimated in kilometers. In how many kilometers the vehicle and can travel in 1 year. Depreciation is number of kilometers traveled into kilometers rate. This method is suitable for vehicles. Last one, sum of the years method. Under this method, so cost of the asset minus scrap value, whatever the amount is in, this amount is, suppose take example, cost of the asset is 10,000 rupees, life is 4 years. Now this 10,000 divided by the 4 actually to find out the registration. Now in this case what we are, the asset is expected to 4 years life. So 1 plus 2 plus 3 plus 4. So 1 plus 2 plus this is equal 3, again 3 plus 3 is equal to 6, 6 plus 4 is equal to 10, total 10. So we have to take in a reverse order. Suppose 10,000 into 4 by 10 into 4,000 rupees the annual depreciation. First year 4,000 rupees, in second year, and again it comes to the reduced by year after, like 4 plus 3 plus 2 plus 1. Now comparison of the fixed installment method and diminishing balance method, meaning so cost of the asset is uniformly distributed, means depreciation is provided uniformly throughout the year of the asset. Now depreciation is charged according to the book value of the asset, as we have taken example 1200, 1080, and that is balance brought down values. Now calculation, every year depreciation is calculated on original cost of the asset. Now in DBM method, depreciation is calculated and written down value of the asset, that is balance brought down. So in the take an example 12,000 minus 1200, 10,000, 800 is a balance brought down on. Next year 9,720 is a balance brought down amount. On that amount only you have to calculate a depreciation certain percentage. Annual depreciation is a fixed in all years. You take example 1200, 1200, 1200 in all years, whereas it reduces every year, that is 1200 rupees, 1080, and so on. Value of the asset here completely written off up to the 0, and now yes, not written off to 0. Impact on profit and loss account, increase in trend and now remains in constant, as we are providing high amount of depreciation in the initial years, a less amount of depreciation in the latter years, and it is balanced here. Now amount of depreciation initially and is a lower, and here initially it is a higher. Now preference, this method is only suitable for the negligible, the assets which requires or needs negligible repairs. Now this method is suitable for the asset which needs only repairs when the asset becomes older. And recognition, fixed installment method is not recognized by the income tax authorities. Now whereas this method is recognized by the income tax authorities, DBA method. Balance of the account, value of asset can be reduced to 0. Here the asset cannot be reduced to 0. Now the important general entries which are to be passed in preparation of the depreciation account or in machine account or in asset account are, now first asset account data are to bank or cash account when the asset is purchased. For the installation charges, the same entries are to be passed. Third one, for providing depreciation, and at the end of the year, depreciation account data to asset account, as depreciation comes under nominal account, debit the depreciation account, and because debit all the losses, expenses and losses, and you are creating the asset account. For the transfer of depreciation to the profit and loss account, now profit and loss account data to depreciation account. Now for amount received on sale of the asset, as we are receiving cash, comes on real account, debit what comes in, so bank account data or cash account data to asset account when the asset is sold. Now for loss arising on sale of asset, profit or loss account data to asset account, and if at all any profit earned on sale of the asset at the end of the sale of the asset account data to profit and loss account, as we are reverse the earlier entry. See here profit and loss account is debited, now here the profit and loss account is created. So we have reversed when we earned and profit on sale of an asset. Now summary or So we have discussed various important methods, fixed installment method and diminishing balance method, other methods from 3 to 10, so annuity method, depreciation method, etc. Fixed installment method, we have discussed the various advantages and disadvantages. Diminishing balance method, various advantages and disadvantages. Now comparison, just now we discussed the fixed installment method and diminishing balance method. Importance point to be for calculation, date of purchase of asset and the commencement of the books of accounts, the closing, whether it is March or April. Annuity method, we have discussed depreciation fund method and deflation method. Thanks for all watching my lecture. Please subscribe and encourage for more and more videos. In the next class, we are going to learn about the problems, the fixed installment method in one class and diminishing balance method in another class. Thank you.